Hey everyone, welcome back to Corporate Decade, the place where we dig through corporate filings so you don't have to. Today we're diving into the world of eSmart Corp, a company trying to link tattoo artists with clients. This report might leave you feeling like you got a bad tattoo, definitely not what you expected. This is a Form 10Q, basically a quarterly checkup. It tells us how they've been doing for the period ended February 28, 2025. It's like a report card, and we're here to see if they passed or failed. They are a smaller company and an emerging growth company, meaning they get some breaks on how much they have to reveal. Let's get right into the numbers. We are going to look at the condensed balance sheets. This is a snapshot of what the company owns and owes. Total assets for eSmart Corp are about $145,546 as of February 2025, a slight decrease from about $140 of the dollars they have that in August the previous year. Assets are all of the things that the company owns. So between August of the prior year and February 2025, their assets have decreased by a bit. Total liabilities are about $179,997. Liabilities are the debts and obligations of the company. When you subtract the liabilities from the assets, you get the equity. Total stockholders deficit is negative $34,451. That negative sign is not a good thing. It means the company owes more than it owns and they have a deficit. Now, the condensed statements of operations, think of this as their income statement showing how much money came in and went out. For the 3 months ended February 28, 2025, revenues are about $5,895, a little bit higher than around $2,900 for the same period last year. Revenue is the money the company brings in from sales. Net loss for the 3 months ended February 28, 2025 is negative $23,014 compared to negative $4,356. The term net loss means that overall they lost money. They are losing more money this year than last year, despite the slight increase in revenue. Ouch. Scroll 6 months ended February 28, 2025 scroll. Looking at the 6-month period tells a similar story. Revenues of $10,346, which is better than $2,900 for the previous year. The net loss is still a concern, with negative $37,529, much worse than the negative $16,511 last year. Okay, one more big table and we are done here. Cash flow is extremely important to a company. Companies can cook the books to look good on paper, but it's hard to fake cash flow. Cash flows used in operating activities is negative $25,531 for the first 6 months. That negative sign is bad news again. They are losing cash. On the other hand, cash flows from financing activities is a positive $25,007.98. Financing activities means money from investors or loans. Without that cash infusion, the overall story could have been much worse. Cash at the end of the period is $763. Basically, the company almost ran out of cash. So what exactly does eSmart Corp do? They say they are an innovative digital platform that aims to change the tattoo industry by linking tattoo artists and clients. Here's a key part. The report mentions substantial doubt about the company's ability to continue as a going concern. That is, the auditor is uncertain about the company's ability to remain in business. This is a huge red flag. Scroll summary of significant accounting, Capology scroll. This section describes some of the methods and processes the company uses to keep its books, value its assets, and recognize revenue. Scroll revenue tier recognition scroll. Here's how they make money. They have a service called AI-powered tattoo artist, which is available as a free trial or as a subscription that people pay for to create tattoo designs using artificial intelligence. Scroll intangible assets relate to the website and API software which the company purchased last year. In their case, the intangible asset is related to their AI-powered tattoo cost calculator API. The company has issued shares of common stock for cash. This means they are selling ownership in the company to raise money, which we saw earlier in the cash flow statement. The company has a loan agreement with its CEO, Dina Vasilenko. This is called a related party transaction because it involves someone who has a close relationship with the company. Now, the most exciting part, management's own analysis of their company, Scroll Promotion and For Marketing Scroll, set to advertise their platform and get the word out. The company will use social media marketing and online advertising. Notably, they don't own any patents or trademarks, but they intend to protect their website with copyright laws. The company has no off-balance sheet arrangements, which is good news because off-balance sheet arrangements can be a way of hiding financial problems. Right now, there aren't any major legal headaches, which is good to IT. Now, my take on all this is a new company. It's not completely unexpected for a new company to be losing money early on as they are still in startup stage. What's concerning is how quickly they are burning through cash, and the going concern warning, they need to dramatically increase their revenue generation immediately. Otherwise, things are not looking good. One possible opportunity I see is exploring collaborations and a queue with manufacturers and other industry partners for long-term growth and revenue diversification and other for good. Thanks for watching. If you found this helpful, please leave a like and subscribe. And let me know in the comments if you have any reports that you would like me to review.